Rajesh, sir, very nice to see you and speak with you again. I think it's about exactly almost 12 months since last year. What I want to ask you is not so much about your trades, but really how you've managed over the last 12 months, which really have been difficult if you're a fund manager, especially if you're not a macro fund, given the challenges macro-wise.
David, thank you very much for having me on. Actually, the current market environment in the last 12 months has been better suited for a value-oriented strategy like us. We never really ran after momentum stocks last year, and so when that entire trade unwound as a result of rates going up, we were not as badly affected as the rest of the market. It has been a tough environment, but value investing, disciplined price choice has helped us navigate this environment better than most of our peers.
Well, fair enough, sir. That said, though, so a lot of things have fallen these last couple of months or so. So I would imagine that pool or investment universe that you now can pick from in terms of where you find your next value trade has gotten bigger. Are you more active now in terms of searching those new trades?
So not really. We tend to be long-term investors. Average holding period for our positions tends to be 5 years, and there's always something that's always cooking up. And we've been lucky that stuff that we've taken pain with and held on for the last 3-4 years, particularly in India and in Vietnam, where we have significant overweight positions, have started to really pay off this year, and that's what has held us in a good light.
Rajesh, Dave talked about the 60-40 portfolio giving you negative returns. In fact, it is minus 15% year to date. I'm just wondering, how should your portfolio be looking like right now?
So look, for example, we have 40% of our fund in financials. We think the credit cycle in our key markets where we have those positions, which is India and Vietnam, has largely played out. We don't think that a rate hike cycle in the next 2 years will have as much of a negative credit impact as COVID did. And these stocks are cheap. Most of the positions we own are at or around book value. One of our biggest positions in India is IndusInd Bank, which we picked 4 years ago. It's up 25% this year in a flat market, and that's because of all of the things I talked about. Credit costs are falling, their spreads are holding up, and outlook is good.
For those looking at buying on dips, what should they be looking at?
Look, I do think that Southeast Asia, India are much better positioned because they didn't have the excessive of massive stimulus, and therefore they don't have as much of an inflation risk. And therefore, for us, that bet has played out through financials. We like financials in Vietnam. We like financials in India. More than 40% of our fund are invested in that space. And then again, if you see a correction like in the second quarter of this year, we have had good positions.
Rajesh, on our screen right now, I'm not sure if you're watching while you're talking to us, we're flashing that one of your stock picks from last year's conference. I remember you telling me and convincing us really why that seemed like a good idea, and it was, really. Just to clarify, on this jewelry play you have in Vietnam, are you still long that stock at the moment, and how are you changing your positions right now around that?
It is still a top 10 position for us. It's up 18% this year. They're having a blockbuster year. They gained share through the pandemic. So in a retail industry where the industry was down 20%, they were up. This year, when the industry has come back, they're growing at 60 or 70%. So this year should be a record year. There's a lot of pent-up demand that continues to drive earnings for them. And so we remain very optimistic. It's a good management team, and they've been executing flawlessly.